Hello, welcome back to another week of Manager's Thoughts coming to you from Kelly at Synergy Asset Management. Today is March 3rd, 2023, and we're super excited to bring you just another market update and economic update of the week. Alrighty, so just as a brief market update, as of Thursday, March 2nd, we saw the S&P 500 as well as the NASDAQ and basically flat for the week, while the Dow Jones gained about 0.35%, just a really slight gain this week, and the 10-year U.S. Treasury yield jumped about 4.08%. So this was definitely the most notable move in the financial markets this week, and also the 10-year U.S. Treasury yield spiked above 4% for the first time since November when we saw interest rates first spike. So definitely a big move in rates this week for a variety of reasons, but that's just your brief market update of the week. Monday morning, we got the U.S. Census Bureau's preliminary report on January durable goods orders. And so analysts expected about a 3.1% drop in the month of January. However, orders fell even more at about a 4.5% drop. You can see there, pretty extreme there. And so a lot of this is just kind of balancing out the supply and demand after really large volumes of aircraft orders that drove a lot of growth in December, as the non-defense aircraft orders in January fell about 55% month over month, following a 105% gain in December for aircraft orders. So definitely just a lot of volatility with different aircraft orders coming in. We also saw inventories of manufactured durable goods in January fall about 400 million or 0.1% for the first time in 23 months. So that's kind of a little bit important to note. January's 4.5% drop in durable goods orders is really demonstrating kind of a rebalancing from December's high orders. This also could turn into a declining trend in the manufacturing activity as we look into the ISM Manufacturing Index a little bit later in this presentation, but just stuff we want to keep an eye on as we monitor the economy. Another really important data point that came out this week, also having to do with interest rates a good bit, was the Case-Shiller home price index for the month of December. And so we saw home prices in December of 2022 increase just about 5.8% year over year. So this was down from the 7.8% year over year price increase in November of 2022. And so definitely settling down a little bit here, as you can see, just kind of like the peak and then as it comes down. From the peak here in June of 2022, home prices are actually down in the Case-Shiller index about 4%. So this is largely because of higher mortgage rates. You can see here that just from this last year or so, mortgage rates are up nearly 100%, while home prices are only up about 5.8%. So definitely some interesting moves as kind of interest rates start to get priced into the mortgage and home price market. Another important data point we got this week was the February Consumer Confidence Index, and so we saw consumer confidence fall for the second month in a row here. You can see that in a little trend line. So we saw it down about 2.9% from January, and this was also about 5.2% lower than what analysts had expected. So definitely coming in a little bit lower than what the economists had hoped, but it really just shows that consumers are becoming increasingly aware of kind of the economic uncertainty. They're becoming increasingly aware of the interest rate hikes. Obviously, they are seeing it in their credit card bills, in their mortgage rates, in their auto loans. Anyone who has an adjustable rate is definitely feeling it, or if they're taking out a new loan. So consumers are definitely becoming a lot more cautious and aware of the situation. However, I will say that it's certainly not as low as COVID and nowhere near as low as kind of the financial crisis era. So still in a good point, but definitely consumers are aware of the economic situation. A final data point I wanted to bring your attention to this week was the ISM Manufacturing and Services indexes. And so we saw a weak manufacturing report of about 47.7%. You can see there on the chart, definitely a little tick down from where we've been the last few months here in the last year or so, while the services index came in at 55.2% there. And so basically what that means is above 50 is above average economic activity, while below 50 is below average economic activity. So we've been seeing this in inflation, that the services industry and costs have continued to roar. So it makes sense that the services industry is sort of at that higher level versus the goods and manufacturing has been kind of slowing down in terms of inflation. And it makes sense why the index would also be down. You can see just in terms of historically, the manufacturing index has not been this low since about COVID time period, about pre-COVID time period, while the services index is kind of in a general range of where it's been over the last 10 years or so on average. And so not too concerning in the services index, but that also might be of concern of the Fed because the services industry is still strong, meaning strong inflation might also be in the industry as well. Although we had a lot of mixed economic data this week, we saw interest rates spike, we also had durable goods, the Case-Shiller home price index, consumer confidence, as well as the ISM indexes. No matter what, we are constantly watching all of this news. We're watching the Fed, we're watching corporate earnings, just so that we can best manage each of our portfolios per their mandate and to take the best care of our clients. Thank you for tuning in to our Synergy Manager's Thoughts update, and we look forward to providing another update pretty soon.